India's mutual fund market is absolutely on fire right now. But let's be real, with so many options out there, how do you actually build a winning strategy for 2025? Well, in the next few minutes, we're going to show you exactly why now is such a unique time to invest, which funds the experts are backing, and a super simple three-step plan to build your own portfolio. Let's dive in. First, I just want you to look at this number, 29,361 crore rupees. That is the insane, record-breaking amount of money that flowed into systematic investment plans, SIPs, in just a single month. This isn't just a statistic, folks. It's a tidal wave of confidence from everyday investors just like you. And believe me, it is completely reshaping the market. So, what in the world is driving all this incredible momentum? And more importantly, right, what does it actually mean for your money? We're about to break down the key trends that are creating this pretty unique window of opportunity for investors right now. What we're seeing here is this really powerful cycle. As more and more everyday investors pour money in through their SIPs, it gives mutual funds a ton more capital to work with. And what are they doing with it? They're channeling that money into really promising companies, especially some of the smaller, high-growth ones. This creates this self-reinforcing loop of growth and opportunity that's just fueling the entire market. Okay, so with all this momentum, the big question is, where do you put your money? Let's look at the different kinds of funds, not as some confusing laundry list, but more like a set of tools, right? Each one is designed for a specific job and a specific type of investor. First up, you've got your large cap funds. I want you to think of these as the reliable family sedan of your portfolio. They invest in India's top 100 companies, the biggest of the big. We're talking about the stable, household names you already know and trust. So, who's behind the wheel of this sedan? Well, it's for investors who want a smooth, steady ride. The goal here isn't some crazy explosive growth. It's about consistent, dependable returns that build wealth over the long haul with a lot less turbulence. Now, this chart, this lays out the fundamental rule of investing, and it's super simple. Higher potential returns almost always come with higher risk. See? Large caps are right at the top. Lower risk, moderate returns. Now let's move down the chart and see what happens when we dial up the risk just a little bit. Next up, mid-cap funds. Okay, so these aren't startups, but they're not corporate giants yet either. They're established companies that still have a ton of room to grow, which makes them a really exciting part of the market. If large caps are the sedan, think of mid-caps as kind of like an off-road SUV. Yeah, you get higher performance and way more growth potential, but you've got to be comfortable with a much bumpier ride. These are for investors who are willing to take on more volatility for the chance at much better long-term returns. And now, for the sports car of the fund world, small caps. These funds go after the smaller, emerging companies that have the potential for absolutely explosive growth. This is your highest risk, highest reward option, for sure. And hey, don't just take my word for it. As the InMoney research team points out here, the big institutional players, the smart money, are actively pouring cash into the space right now. Their confidence in these small companies is a really powerful signal for all of us. Okay, so we've seen stability and we've seen high growth. But what if you don't want to choose? What if you're looking for a nice balance of both? That is where aggressive hybrid funds come into play. Think of these as the crossover SUV of the fund world. They give you the growth engine of stocks, that's owning a piece of a company, with the stability of bonds, which are basically just loans. It's a blend that's designed to give you growth while also cushioning the ride. And the experts totally agree. Radhika Gupta over at Edelweiss calls these funds the sweet spot for 2025. And it makes sense. In today's market, having that blend of growth potential with a stable anchor is proving to be a really popular and effective strategy. And finally, we have flexi-cap funds. The best way to think about this one is like hiring a professional chauffeur for your investment journey. You're not picking the car, you're trusting an expert fund manager to navigate the entire market, large, mid, and small caps, and shift your money wherever they see the best opportunities. It's hands-off investing. All right, so we've covered the what. Now let's get to the how. We're going to walk through a dead simple 3-step plan to build your very own SIP strategy. This is where all that knowledge turns into action. Here it is. The entire strategy on one slide. It's really that simple. First, asset allocation. You got to decide how much risk you're actually comfortable with. Second, diversification. Spreading your money around so you're not putting all your eggs in one basket. And third, regular monitoring. Just checking in on your plan to make sure it's still doing what you want it to do. Let's tackle step 1.
This chart gives you a really basic idea of what asset allocation looks like. So, if you're a more conservative investor and you really prioritize safety, you might put the majority of your money, say 60% or more, into those stable large cap or hybrid funds. But if you're a more aggressive investor with a longer time horizon, you might put a bigger chunk, maybe up to 40%, into the higher growth mid and small cap funds. The key is to build a portfolio that lets you sleep at night.
So here's your action plan. Number 1, diversify. Spread your investments across at least 3 to 4 different fund types. 2, commit to it. Stay invested for the long term, at least 5 to 7 years, to ride out the market ups and downs. 3, check in. Review your portfolio every quarter to make sure it's still aligned with your goals. And 4, this one is maybe the most important. Ignore the daily noise and stick to your plan. Okay, let's pull it all together now. What's the one thing that separates the really successful investors from everyone else? It's not some secret formula, I promise you. It's all about having the right mindset. At the end of the day, long-term success isn't about picking that one perfect fund. It really comes down to 3 simple things: having the discipline to stick to your plan, the wisdom to diversify your investments, and the patience to just let your money grow over time. It's a simple formula, but man, it requires commitment. And that brings us to the final and most important question for you. The goal isn't to be some market genius who can predict every single up and down. No way. The goal is to build a solid portfolio and just give it time to work its magic. So ask yourself this: is your portfolio built for time in the market, not timing the market?